So if you happened to glance at the market headlines on February 19th, you probably saw a whole lot of red. A huge crash on Dalal Street got everybody talking. But what was really going on behind those big, scary numbers? Well, let's dive in and unpack the story of what's being called Red Thursday.
All right, here's the number that probably made everyone's heart skip a beat. The Sensex absolutely plummeted by over 1,200 points in just one day. Now that's not just a little dip. The sources we looked at were calling it a bloodbath, a clear sign of some serious, aggressive selling that started the moment the market opened and just didn't let up.
And it wasn't just the Sensex feeling the heat. Oh no, the Nifty 50 was right there with it, dropping a whopping 365 points. This is important because it shows you the fall was really widespread. It hit the entire market, and the losses just got deeper and deeper as the day went on.
So that brings us to the big question, right? Why? What on earth could cause a drop this steep, this fast? Let's do a little detective work here and examine the evidence to really understand what was going on.
Okay, our investigation is going to start close to home, right inside the market itself. The first major factor, our suspect number one, was this immense selling pressure coming from basically all corners of Dalal Street. This wasn't a targeted hit on just one or two sectors. This was a full-on retreat.
And I'm not kidding when I say the pressure was everywhere. You couldn't just point to one struggling industry and blame it all on them. No, this was what you'd call a classic broad-based sell-off. Investors were just getting rid of their holdings all across the board.
You saw the pain in all the usual places, of course. Banking, financial services, you name it. But here's what's really telling. Even the so-called defensive stocks were down. These are the companies that are supposed to be your safe havens when things get choppy. So when even the safe bets are falling, the overall mood is just overwhelmingly negative.
And all of this created a really powerful domino effect. See, the companies under pressure weren't small-time players. They were the heavyweights of the market. And because giants like Reliance and HDFC Bank carry so much weight in the index, when they fall, they have this massive, outsized impact, and they drag the entire market down right along with them.
All right, on to our second suspect. Now, this one isn't really a villain. It's just plain old smart strategy. You see, after a pretty good run of strong gains, a lot of investors just decided, you know what, it's time to cash in my chips and take some of those profits off the table.
And that brings us to a term you hear a lot, profit booking. It's a totally natural part of how markets work. Think about it. When the market's been climbing and your stocks are up, you sell some of them to lock in those gains you've made. But when a ton of people decide to do that all at once, well, that creates a whole lot of selling pressure, and it can definitely contribute to a market drop, just like the one we saw.
But, that internal pressure and all the profit booking, that wasn't the whole story, not even close. To find what seems to be our main culprit, we have to look way beyond India's borders. The biggest driver behind this whole sell-off, it seems, was a massive wave of global uncertainty.
And hey, don't just take my word for it, the experts agree. As Vinod Nair over at Geojit Financial Services put it, the bears took charge because of unsettled global sentiment. And the trigger? Rising geopolitical tensions. The simple truth is, when the world gets nervous, global markets really feel it.
So how exactly did this global ripple effect play out? Well, it's kind of like a chain reaction. First, you had these geopolitical tensions flaring up, which caused crude oil prices to spike. That spike then fueled major fears about inflation. And when investors get scared of inflation, they often switch into what's called a risk-off mode, meaning they start pulling money out of things they see as risky, like stocks, and move it into safer places.
And on top of that main trigger, it was like a perfect storm of other negative stuff. You had uncertainty swirling around the U.S. Federal Reserve's next move, a weaker rupee, foreign investors were kind of sitting on the sidelines, and lower trading volumes because of holidays in Asia. All of these things came together at once to just make the sell-off even more intense.
Okay, so we've identified the causes. We've got our suspects lined up. But let's be real. The most important question for any investor is, now what? How are you supposed to react to this kind of market chaos? Let's break down some of the strategic advice.
Now, here is the crucial takeaway from the experts, and this is so important to remember. This crash was likely driven by fragile sentiment, by fear, not by a fundamental structural problem with the economy. That is a huge distinction. It was a crisis of confidence, not a structural meltdown.
So in a moment like this, you basically have two paths you can take. On one side, you've got panic selling. That's a gut reaction to fear, and it almost always means you sell at the worst possible time and lock in your losses. But on the other side, you've got patient observation, just waiting, watching to see if the market can find its footing before you make any big moves.
So what does being patient actually look like? Well, first, and this is the big one, avoid panic. Don't make decisions based on fear. Instead, watch to see if the market finds a support level. That's a price point where the selling starts to slow down and buyers start to creep back in. And just be prepared, because this kind of volatility, it might stick around for a little while.
And that kind of leaves us with a final thought to chew on. This whole thing was kicked off by global events that are way outside of anyone's control. It's a good reminder that in moments like these, when the entire market seems to be gripped by fear, maybe the biggest risk isn't actually in your portfolio. Maybe it's in losing your cool.